and welcome to my channel. For those of you new, my name's Dave and I work in financial services, and these videos will be a mixture of my journey and development towards financial freedom. They will be about financial products, and they will also be about improving your financial well-being, so hopefully you can reach your aims and financial goals. Remember, if you like the videos, smash the like button, subscribe to this channel so you can grow and reach a wider audience. Now let's get into the latest video. So this latest video is about my self-invested personal pension plan. So I do have a workplace scheme which I can't contribute, but I do have a self-invested pension plan, so I can invest in my own funds and I can pick my own investments moving forwards, and it gives me the flexibility, and obviously the government will top up it taxably, which will give me better returns. Now the aim of the portfolio is an annual return of 10% year-on-year growth. For 2021, it was annual dividends of £3,000 and a year-end value of £90,000. If we look at the following chart, we started the month of December of 96,873. End of November, year-to-date return was 31.07%. And if we look at the end of December for the year-end, a year-end value of £99,927. A very nice return of 35.73% for the year, well above our expectations of 10%. With regard to contributions, we contributed a regular amount of £100 a month. The government topped up with £25 tax relief, and our annual fees during the month was £14.65. We received dividends of £84.91. And we only record the dividends for our shares, not for our funds. But across the portfolio, our average yield is 2.64%. And if we look at the following chart, year-to-date dividends of £3,201.79. So again, we've beat our expectations of £3,000. And during the month, we received some nice dividends from Sainsbury's, £35.58, which we reinvested for 12 new shares. BP, quarterly dividend of £22.24, and Royal Dutch Shell, again a quarterly dividend of £27.09. And if we look at the following portfolio, predominantly UK based, 84.66% is in the UK, 13.22% is in the Americas, and 2.12% is in Asia. Now moving forward, we may well diversify away from UK more to Americas and Asias, but predominantly for our big holdings, it will all be reinvested for capital growth. And if we look at the first portion of our portfolio shares, 16 shares, 7 in profit, 9 in loss, makes up £77,864 of our portfolio, of which 78% is the portfolio, 66% is in the FTSE 100 and 12% is in the FTSE 250. So if we run through our shareholdings, just a quick overview of the shares we hold within the portfolio. As we said, we hold 16 shares, predominantly based in the FTSE 100, but just a quick overview of the holdings. So our largest holding is Aviva, 4,064 shares, £16,700, 17% of our portfolio, but a nice profit in the month of £1,000. It was bought for long-term growth, has been on a restructuring lately, is very cash rich, and hopefully moving forward in the spring it will give us a very good dividend, a yield of about 5%, but will also hopefully pay a special dividend as it's under some kind of activist pressure. Our next holding is Lloyds, the banking group, 31,780 shares, £15,200, 15% of our portfolio, makes up or profit in the month £313. Again, interest rates on the rise, margin improves, and hopefully next month when the results are due in February will give us a very nice dividend. The next shareholding is Greggs to Baker, 267 shares, £8,900, 9% of our portfolio, a very nice profit in the month of £900. Hopefully we'll get a very good trading statement at Christmas. Again, very cash rich, and hopefully dividends will be reinstalled. But it is on an expansion plan away from the high street, but more into forecourts, retail parks, service stations, etc. Our next holding is Drax, the power plant, the biomass maker, 1,173 shares, £7,100, 7% of our portfolio, and again during the month a very nice profit of £600. Next shares we hold is JD Sports, recent stock restructure. We had 500 shares, now we have 2,500 shares, £5,500 of our portfolio, 5.45%. Has been a very big buying spree in the US, but a very cash rich company. Does pay a small dividend of about 1%, but it's been bought for the growth share, and at the moment we're in 100% profit since when we bought it. Our next shareholding is Barclays, 2,827 shares, £5,300, 5.3% of our portfolio, and again, like Lloyd's, it was bought for a recovery sector with the banking sector, and it will pay a very nice dividend in future. And on that basis, our next shareholding is HSBC, 1,032 shares, £4,600, 4.6% of our portfolio, but it was bought because it was paying quarterly dividends, had a very good yield, but it's monthly based as a worldwide global banking player. So it's bought for diversification away from the UK banks. Now other shareholders we own, Sainsbury's, BP, Royal Dutch Shell, as we've said, give us a dividend a month. We also own Penn the Water Company, AG Barley drinks provider, Card Factory, down to our smallest shareholding, John Menzies, the airport facilities provider, 252 shares, £790, but makes up nearly 1% of our portfolio. Has been hampered lately from the COVID, but hopefully it has regained some services, predominantly worldwide based, and it will be a very cash rich company in the future when flying and sentiment returns to that sector. So as we said, 16 shares, 7 in profit, 9 in loss. Some very good companies, some very good profits. Greggs, retailers, and JD, the retailers, are both 100% in profit since we bought it, but all bought for long-term holds, and as we said, dividend yield of about 2.64% within the portfolio. Now, if we look at the funds within our portfolio, 6 funds, all in profit, none in loss, makes up 22% of our portfolio, £21,966, but a small loss in the month, down £2,000. Now, if we look at the holdings release, Legal and General, a technology fund, £6,300, makes up 6.3% of our portfolio, was showing a very nice profit. Tech sector's come down lately, but there's still a profit since we bought it of 57%. Our next holding is quite selective, Ballygifford Positive Change, £4,200, 4.22% of our portfolio, but a very nice profit of 26%. Very selective, owns about 30 companies, but all good long-term quality companies for the future. Our next holding is US smaller companies, £4,200, 4.2% of our portfolio, and a very nice profit since we bought it of 27%. Our next holding is bought for diversification. It's a global growth, £3,300, 3% of our portfolio, but a very nice profit of 10%. It was bought to diversify our portfolio because it was solely UK based. Now on that basis, our next fund holding is a UK equity fund. Lindsay Train has a very good track record, has struggled lately, but for the last 10 to 15 years, some excellent returns year on year, so we bought with our track record. £2,800, nearly 3% of our portfolio, and a profit to date of 11%. And then down to our smallest holding, recently topped up during the month of £135, is a UK smaller companies. £1,177, 1.1% of our portfolio, and a small profit since we bought it of 4%, but it was bought away from the FTSE 100, give us greater diversification after the COVID recovery in the UK. Hopefully UK companies will grow predominantly faster than the FTSE 100. So as I said, 6 shares, all in profit, 22% of our portfolio, a mixture of sectors. Now, we're not going to increase our fund holdings by the number of funds, but we may well diversify into existing funds we have and increase that portfolio away from being so UK based. But again, our long-term funds held for the next 3 to 5 years unless market sentiments change. So a quick recap, some very nice shares, some very nice profits, and a very nice profit exceeded our expectations for the year, 30% plus, so well in above our expectations of 10% during the year. Remember, if you like the videos, subscribe to this channel, so smash the like button, and we'll see you again soon.